Welcome, everyone. How is it going today? I hope that we are finding you in good health and good spirits at this 2 p.m. on Saturday on a beautiful day. Hope it's also beautiful where you are. Thank you very much for coming today. We're going to be going over some very important and interesting subjects today. Also wanted to say thank you to everyone for being a part of the startup competition, for putting your foot forward and jumping, both foot into the blockchain industry. For those of you who are new to it, and for those of you who've been in it for a while and see this as a good opportunity. We're going to be here over the next few weeks and months in order to be able to help you through the entire time. So just to get started today, a few quick words of admin before we get started and introduce our speakers and panelists today. Wanted to say that this is being recorded, so if you ever need to rewatch it or if you want to share it with other people after, it will be possible. Secondly, we're going to be doing something very in-depth with an actual presentation around how to build a business with all the, the nitty-gritty that's necessary, building off of this panel over the next month and a half. And if you have any questions other than the ones that I'll be asking today, don't hesitate to put them in the chat below, and we'll try to get to them. We have 45 minutes of pretty heavy content to go through today and exciting content. So without further ado, let's jump in. My name is Joachim Miro. I'm the SVP Global Growth for GDA Capital. Also been a partner of MLG, which was one of the two companies that JV'd in order to create GDA Capital. I've sold a business before at a 9-figure valuation, and have built businesses ever since leaving college. Been in the blockchain space since 2017, so I have a lot of experience in building businesses, and from startup going into scale up and then going into more of an established company. And today we have Henrik and Paul with us. Henrik, would you like to first introduce yourself, and then we'll go to Paul?
Yes, hi, my name is Henrik Rasmussen. I am the head of investor relations for a company called TDFi. We focus on decentralized finance, blockchain solutions for real world problems, and have the joy of having in our cohorts about 25 different projects that we've been working with over the past year. We do our best to bring in companies that solve real world problems, and through our accelerator program, which also includes investor relations in terms of both getting money in, but also how to promote your own company and how to fund your own company in the best possible form is a main part of our business.
Super interesting. Thank you very much for being here today, Henrik. And how about you, Paul?
Yeah, I'm Paul Sindernot. I'm the program manager at D-Lab, which is a venture studio. It's got to focus on blockchain, decentralization and distributed ledgers. We have a pretty wide mandate. We made 13 investments so far. We're part of the SOSV family, and SOSV is a global multi-stage venture capital firm that's been around about 10 years or so with over $1 billion in assets under management. So.
That's awesome. Yeah, SOSV is everywhere that I see. I mean, I was at a conference in South Korea. I'll see someone from SOSV. I'm at a conference in Rio. There's going to be someone from SOSV. You guys are really global and quite good at finding good investments. So I'm really looking forward to hearing what you look at in companies when doing investments. Before we jump in, I just wanted to also introduce, so we have the BEN team with us today. BEN means Blockchain Education Network. They've been around since the beginning of the blockchain industry, pretty much helping bring education towards the space. So thank you very much for being with us. They're one of the official partners of Next Stop Blockchain Startup, as well as an official partner of GDA Capital. So thank you very much. We also have Connor McNamee, who's been organizing in the background everything related to the competition. So thank you very much, Connor, for arranging this panel, as well as the competition. So yeah, let's jump right in. So the first question that we're going to go into, we're not going to beat around the bush and go straight into it. So when creating a pitch deck for investors, Paul, what is it that you first and foremost look at, and what are essentially the main pillars that you need in a good pitch deck?
I guess generally speaking, I'm a big fan of the 10-20-30 rule. If none of you are familiar, it's that slide should be no more than 10 slides, no more than a 20-minute presentation. But honestly, 10 minutes, if not less, 5, if not less, and 30-point font. Too often I see presentations with just way too much text on it, and if someone's presenting it to me, I'm more of there are generally two types of people. They're either listeners or readers, and so if you put up a slide with a bunch of text on it, I'm a person who's going to read and zone out to what you're presenting, so I won't hear what you're presenting because I'm reading all the fine text. So those are the general rules of thumb. And just, is it for a customer? You ask yourself also, is it for a customer or is it for an investor, a partner? So you need to tailor your deck as to who you think it is. Yeah, that's what I would say is the general things.
Super interesting. I actually heard that you should divide the age of whoever you're pitching to by 2, and that should be the size of your font in the deck.
Yeah, no, it's particularly like you don't know if someone's on a laptop, on a screen, in this day and age. So you don't know how they're going to be seeing it. They could even be on their phone, right? So just be very cognizant of that. And you don't want to put too much information. You want to put just enough information where it's like, oh, wow, this is kind of interesting. I need to learn more. And just, you want them to interrupt you and ask questions when you're, when you're presenting, and you want people to learn more, or you want them to follow up on the email and ask a ton of questions. So, yeah, stray the line between presenting just enough, but, keeping some under the curtain, so to speak.
Would you say it's safe to say that essentially the presentation should be like a hook? Like the objective isn't to give all the information, but rather to generate interest for a second meeting?
Yeah, I mean, if we're talking to like an investor, then yeah, you want to leave enough where it's like, if you're sending a deck, whether it's like by a semi-warm intro or just completely cold, where it's like enough to hook them to be like, oh, cool, let's have a 30-minute chat. If it's to a customer, it might be a little bit of a different nature. You maybe don't have to withhold as much information as you want. But yeah, generally speaking, if you're talking to an investor, yeah, you want, when we see a deck, we want to be like, oh yeah, you know what? Maybe let's see what's here, what's under the hood. And then we ask a bunch of questions. So
that's awesome. And so Henrik and Paul, like, just a last thing on this question before we move on. Are there any resources that you think are really good for anyone that's on this call to go and take a look at, to see, let's say, example pitch decks or other resources that could help them with this?
There are many sort of standardized presentation materials out there, but I tend to agree with Paul that less is more. If you can use pictures rather than text, it is just so much better of a conveyor of information, especially as we transverse from phone screens to laptop screens to desktop screens. A picture just speaks 1,000 words, and the investors you should catch the investor with their questions, not with them having to read on a screen, especially if they have to go all the way up close. That just doesn't work. So yeah, focus on the message rather than than putting too much text in.
That's great. On my end, like whenever I was building these types of presentations, especially in the beginning when I didn't really know how to do it, what I would do is go on Google and just find all of the successful companies that have become unicorns, and I'd try and find their pitch decks. So Airbnb, Uber, and everything. And the number one thing that I saw is really this 10, 20, 30 rule, as well as like almost zero text, literally just like two small, graphics or of some sort, and then they're just talking about it. And so even when you're looking at the deck,
convey what the problem is, show your way of solving it, and show us how you're going to get there and how I'm going to make money as an investor taking you from point A to point C.
Okay, very, very good.
I would echo what Henrik's saying. Really work on, ultimately what it comes down to is really work on what we think it comes down to is just boil down your pitch to like a 1-minute pitch or a 2-minute pitch. And then you're going to be able to talk about your company for 10 minutes, right? But 10 minutes is a long time to chat. So yeah, if it really helps if you can just really sharpen the pitch to like something as short as that, and then you can just expand from there.
And so what would you say that are the main things that an investor wants to see in a pitch deck like this?
How's he going to make money? The only thing he cares about. How am I going to make money off of this?
Yeah, Perfect. We like to see also some ability, because we're early stage investors. So it's like, like some ability to execute and ship product, whether it's a POC or an MVP or whatever it may be. Just some demonstrated ability by the team to ship, basically.
So
what have
ability of the
what have you
founder?
made so far? What are your do you have any patents pending? I've had companies make pitches and forgot to mention that they have a patent pending. That's inexcusable. You have to show this is a dance. You're dancing with the investor, right? And you want to figure out if you can find the same sort of rhythm here. And you want to work with the investor and get him on the dance floor. And you have to show yourself a little bit. So, get him out there with your interesting points. What are your values? What have you created? How far along are you? For us, we generally take companies in that are already existing. So we're not incredibly early stage. But so what is it that you're bringing to the table? Why will this be a success for you and not for others? Because, we live in a competitive world.
How would you say that it changes between like a pre-seed or seed pitch versus something that's more established? Like what are the main things what will change between what you look for at that stage and at a later stage?
Yeah, I mean, I guess on our, since we're, I'm focused mostly on blockchain and crypto. When we're talking about pre-seed, seed stage deals, some of these companies might not even have a product, might not even have revenue, might not even have users. So what we look for at that point is just quality of the team, because in our experience, the people with like high ethics and energy and vision and leadership and ability to execute. The way I like to describe it is that it's like perfume. When when you know it's good, you smell it when you know it's good. Yeah, and so that only comes with chatting with the team. So that's what we're looking for, and then it goes back to demonstrated ability to ship. But I'm sure, Henrik would say, once you have users and revenue, it just becomes more about data. But I don't know if Henrik has more color.
Absolutely. When you have an existing business, so I mean, we're also focused on blockchain, right? But we have lots of companies coming to the blockchain, and we have lots of blockchain companies coming wanting to expand on their existing business. And we're trying to engage with these people in a manner that lets them expand on their business, but they have to have a clear message, and they have to have a team, they have to have development. And whereas we as an accelerator can help, we're not going to replace everything for you. We're here to support you. We're not here to take over your business and run your business for you. So our main investment is in people. We have to believe in people, because if we don't believe in people, the idea can be eternally good. But if people are not behind it or understanding what they're sitting with in their hands, we can't invest in them.
Super interesting. A question on a similar note: how should a startup value its company?
Good question.
If
you know the answer,
Paul,
tell us.
I'm gonna let you answer that question, Paul.
Yeah,
I've been searching for that answer for years, and I still
yeah. I mean, it depends on what kind of where you are, of course. Early stage, typically it's on convertible notes. It also depends on like, are you gonna have a token and all these things? So you have to think about Wayne Gretzky has a quote. I think it's who's a Canadian hockey player, but he has a quote of skate to where the puck's going, not where it is. So think about where your company is going to be in 18 months and 24 months, et cetera, because it's a lot easier for you to set things up correctly when you're a team of 2 people, 3 people, 4 people, than when you're a team of 15 and you've raised real money. It's easier in a lot of, one, it's a time suck, and you want to be building your business and getting customers and shipping product. You don't want to be talking to legal about reincorporating or new structure, et cetera, et cetera. And it also it's, lawyers know that you raise a couple $1 million, so they know they can charge a little bit more. So it's also not cost efficient. So think about where the business is going to be. Another thing is that we tell our startups to raise for 12 to 18 months. And also think about what bar that sets. Like if you raise at $7 million, let's just say you raise at a $10 million valuation equity round, your next round, your investors are going to be expecting that your next round is at $20, $30 million, right? Pre-money. So can you get there in 18 months? Because that's the bar you're going to be setting that's going to be like your measuring stick. So can you realistically get to a $20 or $30 million valuation in 12 to 18 months? If you can, great. But if you think it's like really high, then, you need to think about that, because investors have, that's what they would expect, a 2 or 3x at every round. And also think you're going to be giving away, if you're raising in a traditional sense, you're going to be giving away roughly 20% of your business at every round. So keep in mind of that as well.
At what multiple have you seen businesses getting bought out in the blockchain space or raising?
I haven't seen any buyouts, to be completely, I've heard about them. I don't know what multiples, like TrueFi, if you're familiar with that. I think that was sort of a buyout. I don't know.
Or even like during next raises. So like when you go from seed to Series A, like what type of multiples are we seeing on revenue when trying to value the company? I know it would be different in the SaaS company.
When the markets are good, it's very good. And when the markets are bad, it's not that good.
Okay.
Yeah.
and crypto world has taken a swung into bear country right now. So we're not seeing much, to be honest. I see our investors pushing valuation down right now strongly because the market's flat. So
Yeah,
interesting.
Paul, I wouldn't say crypto companies are really valued on revenue, because like a lot of, at least it depends what you're building, of course. If it's like a decentralized lending platform on Solana, you're basically covering, like trying to do flash loan, like Aave on Solana, let's say, you're not really, people, you're going to have a token. It's hard to value what the revenues are going to be. So it really depends, I guess. It depends on who you are as a crypto company, I guess.
Interesting. Paul, you mentioned a convertible note earlier. I don't know if a lot of people here are pretty new to entrepreneurship. So could we just delve a bit deeper on convertible notes, like not too long, but just a quick summary of what they are and what other types of like raise mechanisms are there?
Yeah, they're very popular, generally speaking, at an early stage. And the reason being is that it's very low lift. Like the paperwork can be found on the internet, like on Y Combinator publishes documents that have been reviewed by legal that people can just use and just copy paste, change names and dates. So that's one. So you don't have to hire a lawyer to close like a convertible note round if you're very early. You are also punting on valuation, so to speak. So you're not really you're not really valuing the company. It's not a valuation. So when you do raise an equity round, it becomes a heated point of contention of what the valuation is of the company, and there's a ton of back and forth. So that's why they're favored, generally speaking, at an early round. Very popular in the United States. There's two kinds. So what it means is that they're investing in a debt instrument. So it's technically debt, and a convertible note has an interest rate. Safes, which are also very common, safes do not have interest rates. And essentially what that means is that debt is going to be converting into equity whenever you raise that equity round at predetermined terms. Most of the time, it's either a 20% discount, or it's at a $5 million or $10 million, or there's a cap associated with that. And what the cap means is that, let's say you raise a note, $10 million cap with a 20% discount, is that the note's either going to convert at a $10 million cap. If you raise a $50 million round equity valuation, those convertible notes would convert at a $10 million valuation. If you raised, an $8 million equity round, then instead of the cap, the investors would be using the discount. So they'd be converting at a 20% discount to the $8 million round. That's generally what it is, but there's a lot of ways to skin a cat, I guess.
Most definitely. And then Henrik, in later stages, is that also the type of raise that you see people do, or it's something a bit more traditional?
As money grows older, they tend to become more conservative. So in the later rounds, I see less of the convertible notes and more of sort of the sheer equity investments. And this is where we need to bring all of our companies as fast as possible in this blockchain space, because we need some of this conservative money to come into the whole world of blockchain, which will solidify our existence dramatically for the many coming decades, where blockchain will be a massive part of all sorts of finance and other solutions.
Totally. And I mean, like on that note, we've seen a lot of institutional capital, or more institutional capital. I wouldn't say a lot, but more than what we've seen in the past in this wave right now. Definitely still at the early stages of that. But I think it's a good trend that we're seeing. One of the things that I've recognized or realized that as an investor myself is that a lot of the founders of these projects aren't necessarily from a capital markets or venture capital background, and so they oftentimes like they don't think of raising, and so when they do, oftentimes it's either too late or too early. So what's the strategy around raising funds, or what's like a good, you know, few pointers that that we should always take in consideration when considering raising funds?
Know what you're raising funds for. Be very clear on your message. Don't conflate your background with your product. Lots of people tend to do that because they're like, I have all these things that I've already done, and this is the product that I'm trying to promote. And then they conflate the two, and the message becomes unclear. So when you're raising capital, you have to have a clear message. It has to be crystal clear. Otherwise, you don't have a chance.
And simple, yeah.
Totally agree. Like too often we meet, like have a use of funds, which, you know, you can use something like a Gantt chart or however you want to do it. But like, if you tell me you need $1 million, it's like, okay, cool. You need $1 million for how long? You know, if you need it for 3 months, that's not really realistic. It's again, 12 to 18 months, generally speaking. Great. You need $1 million. Like, what are you going to do with the $1 million? Who are you going to hire? When are you going to hire them? And, you know, what are you going to spend on? What else are you going to be spending money on? And totally understand that it's probably going to be wrong in terms of the exact dates, but at least it shows there's some rationale between needing $1 million. Like too many times we meet with founders and it's like, oh, we need $3 million. It's like, cool. Well, what do you need $3 million for? And they're like, oh, well, to like ship stuff. And it's like, well, that's not very convincing. So Henrik's totally right. Like just have that be crystal clear, and that help. And you know, it's not going to be right, but just have it crystal clear and make sure it's realistic. Like if you're just starting out a month ago and you want $10 million, you know, is that realistic? I don't know, but
especially if you've never had that type of money before, it looks
it's
on you. Yeah.
So
it actually doesn't help you to raise a lot of capital. That's the funny thing. If you have a product that is worth X amount of money and you raise too much capital, you're going to wind up having to give money back to the investors. And that just doesn't work. The investors get really upset. They spend a lot of time doing due diligence. You're not going to be happy because you're going to explain why X investor doesn't get to invest in your company and Y investor does. So it has to be, you have to make sure you do the right thing from the beginning.
Yeah, and you have to be careful. Like you see this in crypto a lot. Like a lot of these projects in the ICO boom or whatever it may be raised, you know, tons and tons of money.
Right.
Like 2 or 3 years ago, and like in some cases hundreds of millions of dollars, and so they have runway in like almost in perpetuity. But like you look 2 or 3 years on and nothing much has been shipped, honestly. So the problem with raising too much money also is that, you know, people are like, cool, I can go on vacation for 8 months and then come back and build a product, and then all of a sudden the company just loses complete direction. But you know,
I'd say
you might speak to 10 different people and get 10 different answers, but that's our view.
But that's a huge point. As a founder, everyone thinks, you know, as a founder, you're the boss, and because you're the boss, you're able to take more vacation, especially in the beginning when it's the first entrepreneur. But when you're the boss, you answer to every single other person in the company. So you're actually the one who has the least amount of vacation. That's always on. And that's part of like the game. You know, it's part of the beauty of it. There's a flexibility to it, but there's also responsibility. And that's one of the things I think that any investor is going to look at is if you have the grit and the you know, the necessary time commitment and interest and motivation to make that happen. Just one quick thing, Paul, you had mentioned, and as well, Henrik, like you need to, you should show where your allocation of funds are going to go. But we also have to keep in mind that you have to keep the presentation simple. So there's a whole concept of backup slides where, you know, you'd want to just show that you know where you're going with the money, but then you don't want to spend, you know, 2 minutes of your 10-minute presentation on that either. So it's something quick. This is where it's going to go. And then if people have more questions, then you're ready with a lot more depth of an answer. And this goes the same for most of the slides. I don't know if you would agree with that, Henrik and Paul, but that's at least what I've seen when it was presentations that I really enjoyed.
So my general sort of way of recommending people to do presentations to have a 1-pager, a 3-pager, and a 9-pager that Paul mentioned. The 1-pager is basically what you hand out with your elevator pitch on it. It's what you send people, cold send people, because you cannot expect people to pay attention to more than 1 page when you send them your initial information, especially if it's cold sending. 3 pages is when you've established the first contact, and then you go for the 10-pager after that, which is the follow-up meeting. And then after that call is when the real due diligence starts, and that's when you bring in your white paper, where you have all the details, all the backup slides, everything that has to do with your project is in there. But until then, you're just trying to get the attention of the investor. So 1-pager, 3-pager, the 9-pager. I give often 13 pages on the 9-pager, but that depends on how much information is on it. But in that range. And then you have your white paper, which sort of comprehends everything. And if your white paper does not do everything, then your white paper is not finished. And you need to have that. But that's the 1-hour interview.
Yeah, no, I would agree. Like, everyone's got that pie chart where it's like 10% to investors or 10% to marketing and, 20% to new hires. And, I've seen that pie chart a million times. It's almost a copy paste, but like, just that detailed, and you don't need to include that in the deck, but like if investors ask for it, it's like, oh, here's like something a little bit more detailed than that. It's just nice to have in your back pocket. So.
And it has to fit with the financial projections and everything as well. So
yeah, and it's all gonna be wrong. I don't know how it's gonna be wrong, but just people understand that they're not expecting you to be an oracle. So
but they are expecting you to have the materials ready for it.
Right. Yeah.
Exactly. A lot of them, like, so if you're doing a 1-page, a 3-page, a 9-page, white paper, all your financial projections, everything, that it starts to pile up a fair amount. And so what percentage of time would you recommend that a founder, whether it's a CEO or someone else that's on the team, what percentage of time should they invest towards fundraising once that becomes one of the objectives of the company? Do you think it's like full time? Is it like 20/80? Is it 50/50?
I don't. Yeah, I know a lot of found CEOs. Maybe like when you're first starting out, your job might be to help build and ship product. When you're one of 3 people, 4 people. But once you start to raise, your first round, going into your second and third rounds, practically your full. And founders don't really realize is that when you're a CEO's really full-time job is like capital formation. It's not really biz dev. It's not really shipping product. It's more in capital formation and talking to investors a lot of the time. So I think that's one thing a lot of founders struggle that when we come across, they realize that they have to shift roles, so to speak, into speaking to investors and keeping those lists up to date and reaching out to them every quarter and keeping them updated, your existing ones and new ones that has to be in touch and et cetera, iterating on the deck and everything like that, because, we say raise money for 12 to 18 months. The reason, and then, if you think typically it takes 3 months to raise money, might take 3 to 6 months to raise money to close a round. So, you almost get into the cycle where you're almost always, as a CEO, you're almost always doing it. So that's what we would say.
If you're in the blockchain space, I'd
the,
say
the unfortunate truth is if you stop to look for money, then you stop looking for your business. That's the other part of it. You cannot stop looking for money. You always have to be looking.
One thing that I've seen as well in this space is you're also very, very often speaking with legal, like because of
right. Totally. Yeah. You're CEO. Yeah. You're right. Exactly. You're speaking less on the product and biz dev side, and yeah, totally.
Yeah. Human resource, legal, and capital. It's crazy.
It's inevitable.
Yeah. Well, actually, on that note, there was someone in the chat that just asked, what does that job morph into if you don't need those investors? I'm curious to find a company yet that doesn't ever need investors, but
I guess my follow-up question would be, I guess if you're IPO'd or something, or even if you've launched a token sale, but you're almost still, if you've done a token sale, whether you're anonymous or not, you're almost still this head of almost like basically a publicly traded entity. So you're still doing some investment relations and things like that. But without knowing, like, I'm not, yeah, I don't know if I fully understand. I
No,
mean,
it's very
if you're a
speculative.
business that never needs to raise money,
Yeah.
that's amazing. And, you know, I would love to find that business. And there are businesses like that, but that's amazing. So.
John, I'm curious to hear more about it. So feel free to send a message after. I'd love to hear a bit more and go deeper on that. So something else that that I was curious to hear your thoughts on are, so we've spoken about strategies for raising funds, but now what about timelines? So Henrik, before you were mentioning how you know, right now it's a bit more bare, so a lot of investors are pushing down valuations. Does that mean someone should wait? Does that mean that, you know, how much are you dependent on the macro environment of the market versus like what internally you need in order to raise funds? And how do you figure out those timelines as to when it's like a good strategic time to raise? And if it isn't a time anymore, should you stop trying and then push forward? How does that look? So let's like go into timelines a bit.
If you can afford it, definitely stop when the market is bad. But most companies cannot afford it, and nor should they. I mean, if you go out in the market and you're ready with a token offering and you're ready to raise capital and you have a product that's underway, you can be lucky to get incorporated into an accelerator like ours or a company like Paul's, where the investor really cares. But most investors don't care. They want results. And as such, you gotta hit the ground running as soon as you get some capital. And if you feel that the market only can give you partial investments, I mean, if you can, I would postpone. But most people cannot. So I would use any means possible to find capital, and I would consider lowering my valuation to get in investors rather than delaying. That's for sure.
And then within investors, like, how important do you believe it is to have, especially at the early stages, strategic investments or strategic money versus just like random money of an investor that doesn't care?
Get money in that cares first. That normally tends to happen automatically because the matchmaking happens on a personal level when you're very, very young. If not, then you're going to be in a brutal game with an investor, and you don't want to be there, because there needs to be some sort of understanding for what the new startup company is. Paul will know more about me than that. You're on mute.
I think yeah, I think you're on mute.
Sorry, I'm on mute. Apologies. Yeah, no, I totally agree. And what I would say is companies don't do this enough. Founders don't do this enough. We ask founders all the time a ton of questions, and we ask them to provide a ton of information. And you can do the same for your investor or potential investors. And in fact, we view it as a very positive trait when founders are asking us a ton of questions, because once they're on your cap table, you can't get them off. So it's almost like a marriage. And so, you know, when you want to, ideally, and way easier said than done, totally understand that. But, you know, in an ideal world, you have investors that, you know, demonstrated ability to follow on capital. So you know that they're going to be providing capital when you're like raising the next round and the round after that, et cetera, and that are going to be lifelong partners for you generally. So if you have investors like that, it makes your job an order of magnitude easier when it's like shit hits the fan and you have no idea what that timing is going to be. You know, I don't know what the world's going to look like a month from now. Certainly don't know what's going to look like 8 months from now. So that helps a ton. You know, in a bull market, everyone can raise money and very easy to do so. But in a bear market, really helps if you have investors on board that are fully behind you, aren't just going to invest once, for example, and are going to help you intro them to other investors and things like that.
And so that's perfect leeway into the next question. What is it that you want to look for in investors and VCs? And most importantly, what are the biggest red flags? Like, what is, you know, you said it's like a marriage. So what are the red flags to make sure that you don't end up in a bad marriage?
I mean, I guess what I would say is, you know, do they follow on, right? Have they consistently done so? Are they on their first fund, or are they on like their fourth fund? Like if they're on their first fund, it's like, wow, these are the first time that they're doing this. they might not be able to raise a second fund, right? So it's like all of a sudden, you know, what's their experience, what's their background, what else? I mean, of course, if there's any negative news on the internet about the firm treating a previous company poorly or whatever it may be, or have a reputation for being hostile. That's really what I would say right off the bat.
Interesting. How about you, Henrik?
Yeah, I mean, you know, when you exchange vows, it goes both ways, right? You gotta show the investor what it is that you want and what you expect from him as a new company. And if you feel that, oh, these guys are just giving me money, but they're not really gonna help me market myself or develop my tech or find market makers, but this is a family office. This guy's sitting there, he's just throwing $1 million at me. It's not really interesting for you. It's nice to get money in the door, and if you write the check, that's fine. But then you will have to know that you are going to have to find another investor that really, truly wants to be part in your company, not just someone sitting on the sidelines. The people sitting on the sidelines are the ones that are the worst to work with, because they just expect cold hard cash, and that's all they want to see. And if you can't produce it or can't produce the results in a given time because you need help in some area and they can't provide that, then what's the benefit? That they're going to put you in a hole 6 months from now? You don't want to be there. It's going to be even worse.
Hence why value-added VCs are super important. When should someone consider a crowdfunding round rather than going for a value-added VC?
That's a good question. I think it might be the nature. What I would say is that maybe the nature of the product, if it's a consumer-facing product, maybe hardware related, for example, where it's like tangible, where you can sell. Crowd lending has its virtues. One of the main problems is that you might end up with all of a sudden 100 investors on your cap table, which means you need 100 signatures for future rounds, which means you're sending out 100 extra emails for communication purposes. So just be cognizant of that. It becomes an overhead to manage your existing investors. But there are certainly use cases, if you need to raise money. So there's no, and not to say that crowdfunding is a bad route to go, but just be cognizant of those things.
Most crowdfunding platforms at this point need to have a working product as well. So you might not be far enough ahead in your development to actually go onto a crowdfunding platform.
Interesting. Well, I mean, I find like raising through the token model is almost like a mix between both sometimes, right? Like you're getting VC money and then you're also getting the crowdfunders, and then every person that's an investor is also going to be like a brand ambassador. So in that respect, it's interesting. But I mean, then after that, you also have to look at if you're a utility token or security. 99% of the time, you're going to be a security in the way that the current market is. So definitely something to be very cognizant of.
Yeah, I mean, in the token model, the difference is that everyone gets liquid.
Exactly.
Within 3 months. So it's almost like you're IPOing at the end of the day. So
I find the token offering a little bit different than a crowdfunding model.
Interesting, yeah, because it's so liquid, and so
yes.
people
you
have to convince them to continuously hold it long term. And
I mean, there can be vesting schedules and all that stuff, but still, it's very
and you're probably never going to raise money again if you do a successful token sale. There's there are treasury rounds happening from time to time. I think SushiSwap is thinking about doing one, but yeah.
I've recently seen a lot of people that had raised, or a lot of founders that had raised, in the top 100 tokens. What they do is they don't re-raise through a token. However, one, they have a fair amount of liquidity in like their vault tokens, and then secondly, like then they'll go and do an equity round on the actual company in the future. So that's also one of the ways that I've seen that they then go and get more capital. But definitely something to be cognizant of. So this is a question I want to put both of you in a scenario. Let's say that you tomorrow have an amazing idea for the next top blockchain startup, and you're starting from scratch. Imagine yourselves, you just came out of university, or you're still in university, and you have this great idea, you think it's this great idea. Can you run me through like how your first 3 months would look? Like what would be the first things that you do? Are you going for the team first? Are you trying to build a deck first? Like run me through like what you think, that first 3 to 6 months would look like. With
Great
all your
question.
knowledge and wisdom.
with all of my knowledge, and here's the five-step plan to building a business out of high school. Sorry, out of university. First of all, you run this by your friends and family. You sell it to them, and if they believe in it, then you can start selling it to people outside of that line of people. 90% of all startups get funding from friends and family, so there will be that factor will happen. There will be that rich uncle or well-off aunt that has a little extra in the money in the coffers, and they'll give you a little bit of money for the first. And it's going to cost you some money because it's family. Then you start grooming your presentation materials, and you get it in front of investors as soon as possible. That's my 2-minute answer, 1-minute answer.
Interesting. So you do that even before like finding a team or creating an MVP or anything of the sort?
I mean, you're going to have to be an octopus at the beginning. You have to work every single angle. There's no one doing the work for you because you're the one. You may have a friend or two that want to join the company and make sure that these guys have the qualifications that you need. I would be very, very, very wary in the beginning of just bringing in friends because they're friends. You actually have to look at their qualifications and make sure they can deliver on what you need them to deliver. Everyone wants to join a good idea. Everyone wants to join a good idea. But if they can't deliver on promises, then they have no value for you at all, even if they're your close friends.
Interesting.
Yeah, I would agree. Like, if it was me, I would find someone that I'd want to work on, because like we've seen founders burn out because, as Henrik mentioned, you're an octopus. You're doing so much stuff, and there's only so many hours in the day, and you're working 7 days a week, and it's just insane if you're a solo founder. So I would find someone that I would want to work with that's shitty at that's great at what I'm bad at, right? So there's certain things I just don't want to do because there's just certain things I don't want to do, and it'd be great to find someone that loves the stuff that I don't want to do, because then we complement each other. So it goes back to Henrik's point, like make sure their qualifications, and also don't try and hire people that are just like you. You're never going to get anywhere. You're never going to think of anything innovative. So try and form, whether it's 1 or 2 more people, where it's like you can form this close bond. You get along, of course, but then you're all are sort of different in a way and have different minds and different way of thinking and like doing different things. And then try and work on something where you can, it's like, since it's crypto, it's like, make sure your GitHub, for example, it's a great resume. It's like, here's my GitHub, or here's what we've worked on so far in our GitHub. Feel free to play around. Like we love that when people show us that stuff. So, and then raise a small round, like raise 500,000 or whatever you need to do, like just like a simple proof of concept that you think you can get to, that you think, boom, is going to be the launching point for that much larger capital raise.
And make your data room day one. Make sure you know what your value is, because that's what's in your data room. It's your cap table, it's your IP, it's everything. Just have it there, because it's a folder that will keep you knowing where you're going and what you have that's worth presenting to investors.
And like your business plan and just like interesting.
All of it.
When looking for a founder, so I think that's a really interesting that's a really interesting point that you made, and I agree, like having a founder is primordial to like the marathon that is starting a business. So I've always like, you found that AngelList is a really great place to try and find other founders. Are there other places that you recommend looking when trying to find a founder? If you're in university, then maybe it'll be in the university, but maybe you want someone that has a bit more experience. So where do you go and find like a good partner that will not have the same skill sets or the same knowledge or be studying the same stuff as you?
Good question.
Yeah, that's honestly a good question. I don't know, hang out in the crypto community. There's a lot of Discords you can hang out in.
Hang out in Reddit, hang out in crypto communities. Go attend or find hackathons and,
Yep.
and see
Yeah.
what kind of topics are there and what's being built right now. These are these are the companies building new stuff for the market.
Yeah. Facebook
Yeah, no, that's a
conferences.
Hackathon's a great idea. We do a lot of our sourcing at hackathons. And yeah, that's a great place to find people. So
Let's say that I'm in the process of raising money and I want to get your attention, Paul. Like, what's some of the cool ways that you've seen people get your attention? So that it's not just a random cold call email, you know?
Yeah, that's hard because, you know, like just cold messaging someone on LinkedIn, you're never going to get anywhere. I really wish that would stop. It's insane. But you're never going to get anywhere. And the problem is that so many people do it that even if you do have a genuine idea that, like, you know, you're serious about and things like that, I've just been, what's the word? Like, I just tune out when I see these messages.
You're inundated with garbage there.
Right.
That's
Yeah. So it's like nothing personal. It's just, there's just so much of the stuff that's just like spam, honestly. So you just look like spam. So try and not look like spam, I guess is what I would say. You know, try and find a warm intro, like try and see who knows SOSV or who knows DLab or who knows Paul or who knows someone I work with. Right. True. You know, that's the best way to find intros. Because then it's like, you know, if a friend of mine or someone I know is like, hey, chat with this company. I'm like, oh yeah, sure, of course. Then I'm 100x more likely to read that deck than otherwise.
That's really good. I've also found just in networking in general, go to every single event that you can, conferences. You're on this event right now. This would be a good time if you have a very specific time, not random, like I saw your presentation, but like I saw your presentation. I really liked how you said this specific thing. It made me think of this, like, do you mind if I ask you this question? And then it's like not about investing, it's about generating a real genuine connection with someone else. And then from there, you're able to start creating it. So I think that's to the
bring
point.
up. Yeah, you bring up a good point. We tell our founders all the time, ask for advice and you're going to get money. You ask for money, you're going to get advice.
Exactly.
So like, so even like tailoring emails, like, hey, I'm building this. I really would like your advice on what we're building, or what do you think of this product? Or can you test this out and tell me what you think? You know, if you give me those types of action items, I'm way more likely to interact than just be like, we're raising a round. What do you think? You know? So.
Yeah. Which is why you got to start super early. Henrik, you're trying to say something. Sorry.
As I promote our projects in our cohorts to investors, I don't think I've ever asked for money directly. I present their materials. I ask if they have interest in an introduction. If you go directly to people, they're just going to say, yeah, well, whatever. This doesn't stand out from anything else.
Interesting. It's funny how the human brain works, eh?
Yeah.
So we have a last question. I think this is going to be the last main question before we wrap up. I want to be cognizant of everyone's time. So there's a question that came up about legalities, and I hear this all the time, and I know none of us three are specifically lawyers on this call. However, how important is it where a business is registered? Because let's say it's a token, maybe they don't want to register directly in the States or Canada because of SEC and this and other regulations, but then there's also other positives because there's less risk from an investor side. So what are the considerations that a new startup should take when figuring out where they want to establish their business?
Yeah, I mean, it depends. Again, it goes back to skate to where the puck's going, not where it is. So think about, what you're going to be when you grow up or want to be. And, that vision might change, of course, and definitely will change. But if you're going to do a token sale, it's probably prudent for you to incorporate in Cayman Islands or whatever is, the typical jurisdictions that you see today. That's probably a sensible thing. Most crypto investors are okay with those jurisdictions, so really isn't a problem. But if you're not sure if you're going to raise a token, which is totally okay, think about, if you're most US investors are going to want you to be Delaware C Corps most of the time. So if you're not a Delaware C Corp and you want them to participate in your round, they might ask you to reincorporate. So are you going to be raising money from Europe, US? Singapore also tends to be a popular destination. So I would keep those things in mind. But I don't know if Henrik has any other thoughts.
Oh, I completely agree. You have to register where you can, where it works for your business. We had a company; they were very keen on incorporating in Delaware, but their business is actually going into sort of more EU, Europe, and Asia. And I was like, "What are you doing in Delaware for? It's not going to help you in any way, shape, or form." So they actually wound up incorporating in Estonia and now in India, and that's going to do their business model 1,000 times better. So don't be so focused on where the big that US is such a big market. Everyone wants to get into the US. And at this point in crypto living, I actually recommend against it most of the time, unless you have a very specific US business. Then I wouldn't do it here.
Definitely. I've also seen, for example, Isle of Man, Gibraltar. You mentioned Cayman. Malta used to be a big one, although Malta just had some pretty intense fintech regulations just come in like last week. I don't know if you guys saw.
Yeah, they're still going strong though. They're going to be fine.
Yeah, I think so. But definitely something to also look into. And after that, you want banking in Canada and your company is in Gibraltar, it's going to be a lot more difficult,
Yep.
So you got to look at what your main goals are and then go from there. Probably speak with a lawyer, I would recommend, to answer the question, find someone who knows what they're doing, and they're expensive, but it's part of the business. And that's why you're raising money at the beginning, to make sure your foundation is strong. To finish all of this off, I know there's a lot more people that are here now than when we started, so just wanted to mention we're also going to be doing a second round of this, more in like presentation style, just going through in general what you need, like the main basis of how to build a good business plan and everything. So definitely stay in the loop, and we're there to help you if you have other questions. As a final question or final comment, I just wanted to open the floor to both of you. If you have any like specific recommendations for all of these young, youthful founders that are starting up their businesses, and things that you're looking forward to seeing in the next startup competition in the next few weeks. Closing thoughts.
So I mean, to speak from our company's standpoint, we cherish and welcome any new application that blockchain can bring and AI can bring into basically solving real world problems. And I think, or we think, I should say, that the application of blockchain is inevitable, and we will keep on investing in tokens until we can no longer stand, because it is such an important part of the new world coming up. And I think we think we've just seen the tip of the iceberg in terms of real world application to blockchain. So if you have an idea, believe in it, go for it full hearted. Don't hold back. Don't let Paul and me hold you back in terms of doing whatever you want to do, because we're not oracles either. We have our mistakes and our flaws and our shortcomings. So I strongly encourage you to go along with your entrepreneurial spirit. I've done so myself since I was 18 years old, and it's really hurt sometimes, but most of the time it's a lot of fun. So don't stop.
Awesome. You, Paul? I think you're on mute again.
I keep on muting myself. So one, I just wanted to say, thanks for having me. It's been a pleasure to chat with both you, Joaquin, and Henrik. It's for us, if you're happy to chat with anybody, provide my 2 cents for whatever it's worth. I can, Joaquin can cycle my email, or I can just type it right here, actually. And if you want to email me your Telegram handle, and we can chat on Telegram, whatever works for you guys. Happy to provide my 2 cents. If you can take a look at, go to dlab.vc and check out the companies that we've invested in, and if you're interested in us, that'd be awesome, and I'm happy to chat.
Very good. Well, it was really great to have both of you on the call. Thank you very much for your time. Thank you for everyone that came out today. It was a pleasure. I know it's midday on Saturday, so this really goes to show that you do care and are interested in building your business, and keep doing so. Take the time to learn as much as you can, be sponges within the space, It's the only way, and there's always more to learn, no matter what stage of business and growth you're at, whether you're starting up or whether you just sold a business. It doesn't matter. There's still crazy amount of stuff to learn. So remain coachable, remain interested in learning and developing and moving with the times. And yeah, thank you very much for being part of the competition. We're looking forward to seeing all of your submissions in the next few weeks. I'll also share my email. I don't know if Henrik, you want to do so, but feel free to do
I did.
Awesome.
There was just a direct message. Holy crap, I sent everyone.
Probably better that way. And yeah, feel free to link with me as well if you'd like on LinkedIn, and to share your model. And I'm happy to give a few cents when I have a bit of time. And if you have other questions, feel free to reach out. Thank you very much as well to Blockchain Education Network and Connor for everything that you guys are doing and have done. Yeah, this concludes this panel. Thank you very much for coming, guys.
Thanks, guys.
Cheers. Have a wonderful rest of your day.
You too.